Hey everyone, welcome back to Corporate Decoder, the place where we dissect the business world piece by piece. Today we are looking at George Risk Industries, and let me tell you, their latest report reads like a spy novel, but with less action and more accounting. Prepare for numbers and a solar tax credit. George Risk Industries filed their quarterly report called a 10Q for the period ending January 31, 2025. Let's break it down, keeping things simple and focusing on what matters. Think of this as the company opening its books and showing us if they're making money or just moving it around. First off, this report covers the 3 and 9 month periods that wrapped up on January 31, 2025. It's important because it tells us how the company performed recently. Are sales up? Are they making more profit? This is what we're digging into. George Risk Industries makes security alarm components and cable and wiring tools. They are a smaller reporting company traded on the OTC markets under the RSK ticker. What that means to you? Probably not much unless you are a fan of niche companies that make physical security products. Now let's jump into those numbers. This Form 10Q is just what public companies have to file every quarter. It is like a school report card, but for business. Alright, let's check their balance sheet. Think of this as a snapshot of what the company owns and what it owes. It is a basic concept. They have $558 million in cash. Not bad, but down from 7/2011, $12 million back in April. That's a pretty significant dip, meaning they spent more cash than they brought in that time frame. Keep an eye on that trend. Their accounts receivable, or money owed to them, is at $3.728 million, a slight dip from $3.93 million, $3 million, which means they are collecting payments okay. Inventory is at $11.368 million, relatively consistent with previous numbers. Total assets are at $63.724 million, compared to $60.760 million. It means their value is growing slightly. You want to see that number trend upwards. On the other side are liabilities, debts, and other obligations. Their current liabilities include $3 and $31.1 million dividends payable. That's money they promised to shareholders but haven't paid yet. It went up from $2 as long as the dividends are sustainable to shareholders. Looking longer term, their deferred income taxes are $2.689 million. This is not that relevant, but basically it relates to income tax rules now versus later. Finally, we land on stockholders' equity, which is $56.331 million. This is what's left over for the shareholders after all the bills are paid. It went up from $54.637 million. More equity is generally good news for investors. Now, let's flip over to the income statement. This is where we see if the company is actually making money, like a profit and loss report. Net sales for the quarter were $4.9112 million, down from $5.3094 million euro. That's about a 9% decrease. Not great. The year-to-date sales are $16.1375 million. Yes, $16.775 million. Tap your $116 launch $5 here, $16.775 million. So, the year is slightly up thanks to better performance earlier. Their gross profit, which is revenue minus the cost of goods sold, was $228 million for the quarter, down from $660 million year over year. Again, the long term looks better at $795.7 million versus 8,503 million. What this means is they are making less money on each sale, even though they had that great start. Operating expenses were at $1.2 million, about the same as last year's $1.142 million. So they're keeping a handle on the cost needed to actually run things. Ultimately, their income from operations, which is how much they are earning from their core business, was $1.196 million for the quarter. That is worse than the $118 million a year ago. The year to date is similar, meaning they've had good times and bad. They did get some extra income, about $536,000 in dividend and interest income, plus another $341,000 on gains from selling investments. Smart moves to add some extra padding to the bottom line. Taking all those numbers into account and doing all the math, their total income tax expense is $654,000 for the quarter. It leaves them with a net income of $1.67 million. A big slide down from last year's $323.9 million. Earnings per share, or EPS, tells us how much profit is allocated to each share of stock. Their basic EPS is $0.33, not as good as last year's number of $0.666 per share. Now, the statement of cash flows shows all the money moving in and out of the company like a checkbook. A lot of numbers on here, but here's the gist. Net cash from operating activities was $3.214 million. This number is good. Operating is the core business operations. Investing activities were negative $26,000. They are spending a bit to buy property and equipment. Financing activities were negative for $4.48 million. They are buying back stock and paying dividends, taking the cash away. Lastly, here are supplemental disclosures for cash flows. This quarter, they paid $320,000 in income taxes and received $1 more. Alright, that is it for numbers. Let's look at a different segment. There have been some updates to accounting rule books that the company has to use to keep everything above board. In November, the Financial Accounting Standards Board, or FASB, issued something called ASU No 2023-07, which is about making the way companies report different operating areas more clear. George Risk is checking this out, but do not expect it to have too much of an effect. The company has some investments, mostly in publicly traded stocks and state and municipal debt. These are rated as level 1 or 2 assets. This means the value is coming straight from the market. The company's strategy is that the investments mature between now and 2050. Now, there is this part about legal stuff going on, but surprise, surprise, there was nothing interesting enough to mention. Market risk basically means the business is sensitive to large shifts in things like commodity prices or interest rates or foreign exchange values. Luckily, they claim they don't need to discuss this. Finally, an interesting item, controls and procedures. Debts, their CEO and CFO, who are the same person, say they have some weaknesses and a material weakness with their control. Specifically, their size makes it tough to separate duties. I guess that is small company life. They also state that the company has hired a controller and has a secondary review with an outside CPA and are actively working towards compliance. Good? Alright, that wraps up this SEC filling now. Let's put this all together. George Risk Industries is making a profit, but sales are down. They seem to be working on improving their operating deficiencies. But you see, things are not improving fast enough. Also, there is only a single person as CFO and CEO, which is never optimal. On the plus side, the company's strong cash position and lack of debt give them some options, but there is a lot of strong competition, and this is just not a space with an obvious high growth runway. Now, for that solar tax credit, it seems like George Risk made an investment in federal solar tax credits. That seems to be a great opportunity if they play it smart and amend their taxes. It might also be risky because, government regulations are always subject to changeover. Overall, I'd say keep an eye on this company, but there may be better opportunities out there. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives. See you next time.